Now we expand into some of the other data points, and a lot of it's going to focus around the real estate side, but we just wanted to wrap up some of the Philly Fed manufacturing, because in the previous segment, we talked about how the non-manufacturing was better, but here you can see the manufacturing actually got much worse. Expected at negative 7.5, came in at negative 24.3, and Philly Fed manufacturing, ISM manufacturing are typically pretty close together. So you get an idea at just where some of that stress is going to come. There, it can deviate. I'm not saying it's a perfect line, but it gives you an idea in terms of the underlying trajectory, which has been confirmed by other regional Feds as well. Now, Philly Fed's 6-month price forecast has come down. That is a positive for some of that normalizing of the inflationary side. So it's fallen to the lowest since May 2020. Again, that's why it's always important to look at multiple data sets, because if you can, I could easily create a fantastic bearish narrative. I could easily create a fantastic bullish narrative, but that's a disservice. Now, the idea is, where do you want to park your money? How do you want to park your money? And what makes the most sense? Baseload power, great place. You know, there is a commodity shortfall when you look at some of the base metals. Really important place to be focused on. So January marked the 8th consecutive month-over-month decline for PPI manufacturing. But again, it's the 8th consecutive month of declines, but look at where the declines put us. And that's where we continue to talk about the importance of zooming out. Is it better than it was? Yes. Is it back to normal? Far from it. And that's that caveat that we keep coming back to, which is why we talk so much about where the Fed has to be different, why even though some of the old pressure points would really cause them to blink instantly, they just don't have that luxury right now, which is why we continue to see these pressure points. Then when we look at Philly Fed manufacturing inventories have gone up, prices received coming down, still expanding, but coming down, inventories improving, which is why it's not surprising to see manufacturing decline, because inventories are getting back to those and really extreme levels, which is why, you know, you're going to cut maybe either cut half or somewhat of the additional volumes that you're producing, trying to balance some of that activity. When you look at, again, U.S. Philly Fed orders minus inventories, you get an idea of just how inventories have gone up, orders improving, but inventories have surged. So even though orders are still contracting at a slower rate, but still contracting, you get an idea of kind of where we sit. Advanced economies, loan demand just isn't there, which again is going to slow down that cycle. Credit impulse are going to pull back. And one of the key places where you're getting that, as we show, if you look at just that blue bar, mortgage demand is down a significant amount. And it's not surprising. As of January, single-family existing home sales have plunged 36.1% year on year, which is the worst annual drop since May of 1980. Again, it's a problem. You could see that it bounced here, and when you look at the 80s, there was a fairly hard bounce off this low. The problem is going to be, where is their volume? Where are rates? And again, inventory is important. Do you have willing sellers? Is there going to be enough? Rates in 1980 were at 17, 18%. You know, we're at 6%, but people have been unwilling to adjust their pricing on homes, which is why you get this, this Texas standoff on who blinks first. And at this point, nobody. So that's where we're sitting. So then you look at the MBA mortgage applications slumped to the lowest level since 1995 last week. The 18% year-over-year week drop was the largest since 2015 as mortgage rates went back up. Again, as the Fed funds expectations go up, as more pressure on rates goes up, that's going to be the case. Purchase applications are down 41% year on year. Refi applications down 72%. Because again, why would you ever refinance? Because you likely got a mortgage rate that was anywhere between, even if you were in 2011 on, you were at what, 4% to 5%. Maybe you didn't take advantage if you were at 5.5%. So again, you're kind of in that, why would you ever refi? So then when you look at U.S. existing home sales, seasonally adjusted, U.S. existing home sales fell for the 12th consecutive month to their lowest level since October 2010. The 37% year-on-year decline was the largest on record. And then the existing home sales were down 0.7% month-on-month versus the estimate of being down 2%. And then when you look at it, again, it's the flatlining. It's not like we're collapsing because everyone's going to point to, oh, look at the year-on-year numbers. Look how terrible it is. It's like, well, it's bad, but month over month is just, you're not going down at the same rate. We're kind of flatlining, and that's going to remain the case, and you have a really tough comp. So the year-on-year numbers are going to look worse, but it's important to appreciate that the month over month is still declining. And that's what we like to look on both different sides. Now, new construction in the pipe should have positive impact on inventory crunch, but consider the fact that even if every single one of the single family homes hits the market today, we'd still just be back to 2015 levels of available inventory. And again, that's who blinks. Like, at what point do people say, well, I missed the top of the market. I'm not selling my home for $1 million. I'm going to sell my home for $600,000. It's still going to be above where you bought that home, even in 2010. It's just, where does that fear and greed kind of balance out? And that's where you have that back and forth, which is why we still think there is significant downside in the real estate market on the pricing side. Housing units authorized but not started on the multifamily side, you can see surging to the highs. 5+ unit building permits going back up because people are going to need units to live in. And it's important to look at, if you also want to change your demographics, you need to enable people to have a place to live. And that's why there's a lot of that back and forth. U.S. existing home sales inventory year on year up to 15.3%. But you can see it's also because you had, again, not a lot of buying. So it's not that inventory surge, it's that interest waned. And then the intent of housing starts, single family built for sale, again, coming down. Built for rent is kind of moving sideways, but you're getting an idea of just where things are in the world and why we're going to stay in this situation unless we start to see some real shifts in that sales market, in that pricing market. National single family rent index year on year came down, but still higher. And again, going back to 2005, it's still the highest it's ever been. We are off the highs. Clearly we are off the highs. So it's not as bad as it was, but it's still above historics. And that's when you start looking at CPI, you start looking at the lagging factors that owner's equivalent rent factor into. And then when you look at construction employment has held up despite weaker housing conditions, and the rise in infrastructure spending contributed to non-residential construction jobs, which is going to persist, and that's going to absorb some materials, some people. So again, you're still going to get a problem when you're looking at trying to bring down the cost of building a home, because you have that kind of, again, that standoff. And that's where we're in this precarious point of who blinks first. And again, we think that prices come down, and then as prices come down, these prices will have to follow with it. And that's going to be, I think, a bigger component of where we are. Real home prices and mortgage demand, the spread between housing units completed and those under construction has moved back lower and remains deeply negative relative to history. And real home prices versus mortgage demand. I mean, going back to 1990, this is the worst it's ever been. And that's a problem, which is why you don't have anyone looking to spend, because real wages are still negative 1.5% year on year. You still have inflation moving higher, wage costs coming back down. So in wages really not growing, and that the asset price versus the wage increases are still so bifurcated that we're going to continue to see that pressure. Remodeling customers. And I think so. Eric is a great follow on Twitter. He is someone who follows this intently and is working with the John Burns Real Estate Consulting Group. They've been fantastic. This comes off of, and they did a deep dive following the Home Depot numbers, because the price sensitivity is not just driving down volumes. Remodelers are telling U.S. customers are increasingly trading down in terms of product quality, price point to stay in budget. So again, you're still seeing some of the remodeling, but it's getting moved down and lower, which is, again, at some point, then you just don't do it. And that's where we think we're shaking out. And you saw a lot of slowdown in Q4, which Home Depot talked about. And we think that, again, that's moving down even further so far in 2023. So that's what we have for you on the real estate side. In the next segment, we're going to go deeper into Europe and where some of those shifts are continuing on the data front.